Hello, everyone. Thank you again for joining us this morning. We're talking today about a couple of great F Street opportunities we have coming up. Specifically, we'll talk about F Street Iron Block, a deal we've been raising for just over a few weeks now that we're going to be closing over the next few weeks as well. In addition to one of our new developments that we just released earlier this week, really diving into the details. Who's joining us today? It's going to be myself, Nick Young. I'm the Director of Development and our General Counsel, as long as Josh is going to be joining here with me in a minute. So specifically, F Street, who we are, we're an alternative real estate company. We develop and acquire assets throughout the United States and really support our investors in their real estate investments. Our goal is to plant money trees. So what we're trying to do is work with investors and place investors' capital into great, exciting opportunities and continue to grow that through our investor network. So if you wanted to, Josh made it in. So we wanted to talk specifically about what we're releasing is the F Street Investor Summit coming up this October.
Yeah, second annual summit. Really excited about it. It was a great event last year. We hosted about 75 of our investors or people on our network. Fun day of tours and dinners and drinks and presentations and talking about our company and our pipeline and everything F Street. So we hope that you attend.
Yeah, absolutely. So there will be more information as well. You can actually visit fstreet.com/summit and reserve your spot today. So please go ahead with that. Otherwise, you can scan the QR code on the screen. We'll be sending follow-up emails as well over the next few weeks for investors to get the date reserved. Again, it'll be fun events of just getting to meet F Street team, talking about opportunities that we've gone through that we're going to be raising, and really just getting to meet us and the team and other investors and partners that we have.
That's a lot of fun.
So again, we'll talk about today. We really want to talk about the F Street Iron Block opportunity. We're on our final stages of raising here, and we have less than
600,000. I think
less
right
than
now.
600,000, maybe less than that on the $2.7 million raise. As mentioned, we'll be closing here in the next 3 weeks on the opportunity, and really, we love this opportunity. It's a great investment in downtown Milwaukee at really one of the best locations you can possibly get in real estate.
Absolutely.
Which is one of the main benefits of real estate itself.
Yes. So a little bit about why invest on this opportunity, or why are we so bullish on this opportunity at F Street? Number one, it's a landmark asset, historic asset. It was completely renovated in 2014. It's in immaculate condition. We've been at the property several times, touring it, meeting with the tenant. As Nick said, it's an irreplaceable location on water in Wisconsin. I believe it's the second or third most busiest intersection in the city and the state. Directly north of the Third Ward, great egress to the highway. Just a really exciting opportunity, and directly southeast of about a 350 plus unit apartment project and in a newly renovated office building directly to the west of that. At the Chase building. So really just a lot going on in that location. We have the deal structured as a 15-year lease, so long-term income, 2% annual escalators over the 15-year term, zero landlord responsibility, which is great, essentially a coupon that's delivering 10% plus cash on cash over the first 5 years of the 15-year term and growing each year after that. So a lot of really positive things, right?
Comparable to like our note fund, for instance, where we have the 10% promissory note. That's obviously 1099 income. This is investment in real estate. So like we talked about, strong cash flow. You're backed by a tenant that has 8 figures of revenue annually, has been in business, as mentioned below, for 50 plus years. But here you're investing in real estate, so you're getting the tax benefits. You're getting the day we buy this asset, you're gaining those depreciation benefits. You're getting the debt pay down, that long-term value creation. And we talked about money trees. I mean, once we have investors paid back, our goal here is to pay back investors between year 5 and year 10 with that cash flow and then a refinance opportunity or a sale. In the event investors are paid back, you're receiving that monthly payment still from the tenant's rent. So that's why we love this opportunity, having that 15-year absolute net lease with those extension options on a real estate asset that's truly on Main.
Yeah, and just kind of highlighting the tenant profile here a little more is, we when we're evaluating any investment, especially in the commercial segment, which we're doing here, this business and the tenant, underwriting them, they've been in business for 50 plus years. They've never missed a rent payment. They recently completed, we get the question a lot, why are they selling their real estate, right? Well, they're an operating business, right? Their margins are higher in their operating business than owning real estate. So they have elected to continue to focus on that going forward. as in entered into some sale leasebacks, right? Providing them with some liquidity, focusing on their operations, focus on growing their business more and more efficiently over the foreseeable future in the 15 years that, next 15 years and beyond. So we've kind of mentioned a lot of these items, but the physical asset, about 45,000 square feet. It was fully renovated in 2014. Historic asset, great cash flow out of the gates and continuing each year with very minimal landlord our responsibilities. And then the tenant profile, one of the largest DSOs in the state with 50 plus years of a track record. And the lease is backed by the parent company. So really excited, as Nick said, about this opportunity.
Yeah, and going over like the physical asset and the location itself. We talked about it earlier. It's located on truly main in downtown Milwaukee, Wisconsin, which you really can't beat. I mean, we look at it as this is a covered land play. You're buying a building well below replacement costs. You're own one of the best pieces of physical real estate in the state. Kind of what we can talk about specifically is kind of just for those of you who might not be familiar with Milwaukee itself is just how critical this site is. So going over a map, I mean, so this is, if we just go at Google Maps here, this is downtown Milwaukee. You're at really the central business district is just right around this area here. Kind of like a highlight. The central business district is right around is this area. And then if you zoom in a little bit specifically, I'll get on the specific asset. The specific asset itself, as mentioned, is on Wisconsin Avenue and Water Street. Wisconsin Avenue is really one of the main thoroughfares. I mean, if you look down Wisconsin Avenue, you're looking at the famous art museum and the sailboat that it looks like. You've got Northwestern Mutual's nearly $1 billion investment less than 4 blocks away. Your major office buildings are your U.S. Bank building, we've got one right here, and there's also a large investment here, which is across the street. Our asset is right here. So you're truly in one of the best locations. The Chase building Josh mentioned earlier across the street had a 10 plus million, 30 million acquisition, 10 plus million renovation. 100 East Wisconsin, also across the street on the river, which our building has views of the river, is going to have a 100 plus million redevelopment into nearly 300 apartments, all as a historic redevelopment. So you're really buying truly one of the best pieces of real estate in downtown Milwaukee that you can acquire. And not only that, you're getting 15 years of income from
Right.
it.
That's great, Nick. And the other important thing to note is, with the vacancy factor in Class A office in downtown Milwaukee, it's really low right now.
Right.
So while we don't always target office assets right now in this location with 15 years of income in place, plus the fundamentals being really strong, this is a great opportunity in the event there's any backfill risk if something happens to the tenant. Now, we of course have covered that. We don't anticipate anything happening based on their long track record and their how quality of an operator they are. But it's good to note that the vacancy level in this quality office space, it's only 45,000 square feet of office. It provides for a great opportunity.
Yeah, absolutely. And again, if anybody has questions, here we want to make this interactive. So if anybody has questions, again, please feel free to ask, but we'll continue to go through it. But again, we're talking about really why we love this asset, why we think it's a great opportunity going forward.
High level here. We put together for every one of our deals sources and uses of our capital, looking at total capitalization of the project, and then how we would be funding those projects. In this particular deal, it's pretty simple. We're looking at debt and equity. We have term sheets for the dollars you can see on there for about $5.5 million. The remaining dollars come in via equity. We are about $2 to $2.1 million already committed and invested, and the other $500,000 to $600,000 we imagine that will be fully invested in the next few days. So you can see the large majority of that is the purchase price of the actual physical asset, and then of course we have some other legal and soft costs and fees and reserves built in that you can see here. I don't need to go through each line item, but a high-level project summary shows the $8.1 million of total costs.
Yeah, absolutely. And going through the investment structure, we talked about it earlier. How our structure on most of our deals, like this one specifically, is Class A investors receive that 7% preferred return. That preferred return is paid first, followed by any distributed cash goes to pay down the investor's initial capital. And then once all of that preferred return and all of that investor capital is paid down, that's when there's a split 50-50 with the Class B members, which is the F Street team, and the Class A investors. Again, they're there in perpetuity. So when we talk about this asset specifically and talking about how the investment structure works, this is really truly an example investment scenario. As I said, we always try to model a certain period. We look at this asset with the current debt we're finalizing and the arrangement, looking at a 5 to 7 year term, and then somewhere between year 5 and 7, refinancing the asset or selling the asset and returning as much investor capital as possible, depending on the interest rate environment. And from that point, if 100% of investor capital is returned, which we project to do sometime between year 5 and 10, investors have all their money back plus their preferred return, and you'll still receive income. I mean, we talk about money trees. It's, the infinite return idea is our investors will continue to get infinite return and will continue to cash flow the asset going forward. So again, the way we look at this is, during the first 5 years of the asset or the first 7, it's over a 10% cash on cash return. We're actually still finalizing with our lender here on whether or not we're going to be doing an interest only period for the first period to have increased cash flow in the first year. So there's a few items we'll continue to talk about as we finalize here. But that's just really the general payback period.
Yeah, and if there are further follow-up questions regarding the specifics of the numbers, we are happy, me, Nick, our entire team at Esther are happy to hop on calls today, tomorrow to kind of go through that in more detail, go through some sensitivity analysis, looking at different optionality and when we could refinance, what assumptions we're making that are market driven to get us to our numbers. So we're happy to talk through that.
Yeah.
Okay, so just quick high level of the critical dates here. We're targeting a closing toward the end of August. And capital due by August 22nd. Here it says August 15th. We're now targeting August 22nd for the capital.
Yes.
And then likely closing that following week. So slightly off here, but just about $500,000 remaining. End of August closing and capital invested in legal documents completed by August 22nd at the latest.
Yeah. So of course, if there's any interest, like I said, a very limited amount left. So if there's anybody that is interested and you're looking for to be in this opportunity, we would strongly recommend reaching out quickly because we only have $450-ish thousand left, and we want to make sure you get in before we acquire the asset here.
Definitely. All right, so we did. Now we're switching gears. Access Apartments is our multifamily development that we're breaking ground on this year. We've been working with the city of West Dallas. They've been a great partner in part of a private-public partnership. They've been a great supporter of this project. We've been working with them closely. Finalizing our development agreement right now with the city and super excited about this 2-phase multifamily project. If we go to the next slide here, we can see that this is a phase project. So we would be starting on phase 1, which is 2 stacked flats or garden style apartment buildings, which you can see in the picture. Those are 2-story separate ingress, egress, separate garages for each unit. And there's 42 units, so 221 unit buildings. That would start in November of this year, and then phase 2 would start March of next year. 105 units, which is the larger building. We call that a stick-over podium building, common elevator, common corridors, more of a traditional multifamily living. So I'm really excited. The full project would deliver in about Q3 of 2027, but the 2 garden-style units that we're breaking ground on this year is about an 8 to 10 month construction timeline. Pre-leasing would actually start, call it Q2 of 2026, so pretty soon actually, and then going through a lease up to get those 42 units leased really efficiently next year, hopefully.
Yeah, absolutely. So one of the reasons we love this deal. So, looking at the site itself, so this is a redevelopment. This is an infill. We call it an infill development. So West Dallas is located, basically just west of Milwaukee. So it's one of those strong suburbs of Milwaukee that's really seen a lot of growth and resurgence over the last few years. Also has had a really strong team. Their mayor, their development director, their team has been really supportive of development, supporting businesses. And that's led them to, they have one of the lowest vacancy rates in all of the metro Milwaukee area because residents really love living there. Where we put this development specifically, so this is actually the demolition of an old church. The church has been abandoned for nearly a decade. The city is supporting us on helping us provide a loan to demolish the current church, which is almost halfway done. So we're going to be finished demolishing it here over the next 45 days. And once that demolition is completed, we'll be starting construction in November. And with that, that's really why we love this area and we love this project. Is great submarket, really we're developing these garden style units and these mid-rise apartments. The garden style is just not something that's in this submarket. And what we've seen really successful in some of our developments in the Metro Milwaukee area.
Yep.
So we're excited about that. Of course, the fundamentals are great too. Great strong returns, our yield on cost going in, which is that measurement of taking your in-place net operating income divided by your cost. We target 6.5+%. That's what you want to look for an investor, because you really want to find that yield between what you're selling an investment for and what you're building it for. So here we're at a 7.39, which is targeting a over 20% IRR is what we're projecting. And talking about earlier, the market fundamentals. Metro Milwaukee, we've seen growth. I mean, it's been all over the news. The Midwest, and specifically the Metro Milwaukee area, has really seen strong rent growth. We're not seeing rent reductions like you're seeing in the Southeast. It's great, strong market fundamentals in Milwaukee.
Yeah, and the other interesting thing too, Nick, that you kind of alluded to is, the proximity to Milwaukee. That's super critical, right? But when you're constructing in Milwaukee, it's much more expensive, right? The rents are higher to justify the cost on some of the projects being built in downtown Milwaukee. Our costs here are super competitive. Our land is obviously cheaper than downtown Milwaukee, but the proximity is great. So our rent, or our value proposition to prospective tenants, right, in our building, is they're paying much less in rent than Milwaukee, but they have a great commute. They have access to amenities in the West Dallas market, but they're a short drive to Milwaukee and all the greater amenities. So we have, when you look at location, when you look up market fundamentals and vacancy, when you look up current absorption on existing units and how well they have performed, we're really excited about delivering a product that really fits in our parameters. And then the second piece of that is when we underwrite our rent in our model, we're being very conservative right now, right? We always work with a third-party market study provider that's very reputable, Tracy Cross. We're actually underwriting our rent, call it 10 cents lower than that, right? Mm-hmm. So we want to be conservative, knowing that we have upside and room to push rents over time. And just a couple of the other items we talked about: public-private partnership, the TIF benefit, 27-year PAYGO TIF, depreciation benefits, right, which will be realized in 2026 with the project being delivered then. And then further in 2027 for the stick cover podium. And then a little bit about being able to, part of the reason why we love multifamily, right, is taking advantage of rental increases on a year-to-year basis, right? Commercial leases, you enter into 10, 15-year leases potentially, and your escalators are locked in, right? There's no better hedge of inflation as a property owner to be able to increase your rents when the tenants renew their leases or when you replace that tenant. So a lot of really positive attributes about this deal.
Yeah, absolutely. And rallying on that location. I mean, talking about here, we just have some of the base renderings. I mean, the site, we are approved. We're able to build this by right. Really now it's just finalizing all of the details, pulling the permits, and moving the project forward here in November. And talk more about the location. I mean, you can see on the south side of the screen here, this is Greenfield Avenue. I mean, we're 4 blocks from the highway. So we're 4 blocks from the highway. We're 4 blocks from the park. On the north side here, you can see, bread peddlers. It's, great walkable area in West Dallas. So we always talk about location. I mean, that's one of the strong location benefits is great access to commuting to work. You're close to downtown. You're also close to the west side and the western suburbs, which is another huge job market, and great access to other amenities.
Yeah, and the other nice thing is with the location, I mean, the city of West Dallas is committed as West Dallas continues to mature and develop, right? And having strong leadership, this is an area where they're focused on, right? They want this project to succeed. It's beneficial for us, the investors, but also the community and city leadership, right? So we're super excited that we have a great partner in the city of West Dallas.
Talking about our typical amenities.
Yeah.
So, again, this is a Class A apartment building. I mean, we do have the stack flat garden style. Again, we talked about that. Those will construct earlier. We can start to collect rents sooner. And the mid-rise will obviously be delivered on a later date. Strong Class A amenities. I mean, we have the rooftop deck. You have an outdoor patio area with a dog run, with grills. We have a community room, Class A fitness space, and then co-working space. So really, all those amenities that tenants are looking for those Class A amenities to have that live, work, play feel in the apartments.
Definitely. And we, in our pre-development process with our builder and architect, we go through this process to make sure that we are competitive in the marketplace, right? Not just the types of units, the size of the units, the amenity set. We want to make sure that we're delivering a product that will be leased, right? So we do this on every one of our projects. We spend significant effort before we bring it to our investors. over a year to go through a pre-development process, a planning process. All of this kind of factors into that final product, which becomes investable, right? So super excited to share the final product and get the equity raise done in the next 60 to 90 days here. Couple renderings here.
Yeah.
And then do you want to
the capital stack specifically? I mean, right now we're obviously finalized. We're about approximately 60 days, right around between 60 and 90 days out from closing, working with our debt partners, but really our general capital stack. Total project cost is approximately $37.4 million. Of that, we're going to estimate that our loan is going to be approximately $25 million, somewhere between 25 and 26 million, with investor equity being around that 12.4 number. And again, where that all goes. I mean, we have our hard construction costs. That's obviously a large piece of it. You have the acquisition costs. So when we acquired the property and then a portion of that, we're actually including demolition in here as well.
Right.
Of course, contingencies. So between our general contractor and our contingencies, we have a large piece of that. Architect and engineering, Rinka's our partner here, has done a great job. We've worked with them on multiple developments. Carrying costs, all of our soft costs associated with the property, developer fees and construction fees, and then of course, additional reserves as it goes. So very standard capital stack, really straightforward. So, and we'll go over the investment structure as well.
Yeah, so investment structure, talking a little bit about the capital structure of this deal. This kind of just highlights our traditional waterfall. So we're paying an 8% preferred return on outstanding capital, and then 100% of that excess capital goes to pay down the investor, all of the $12.4 million of capital that we'll be raising for the project. Once that is complete via cash flow refinance and most likely a sale, that's what happens is a split, 60% in favor of the Class A, 40% in favor of the Class B. So this just kind of runs through an estimated timeline. We kind of talked about the construction start of phase 1 and then subsequently phase 2 in early 2026. And then through the construction and lease up period, our goal is to get to the capital markets to execute on a refinance. So you can see the time there for the refinance and distribution highlighted right there. And our goal, and the question is, why do we do that, right? Well, we have construction debt on the asset. And when we go to recapitalize the asset and call it month 30 to month 36 from the time that we start, is we want to optimize our cash flow. We want to reduce our interest rates. We want to reduce our debt. We want to make this project cash flow. So likely replace the construction debt with a stabilized loan that reflects a stabilized asset, meaning it's not just an asset that we're building, it's an asset that we've built, that we have 95% leased, and now that appraised value, right, that we go through that process during our refinance to increase value and recapitalize the project with a new permanent loan on the product.
Going specifically into the investment timeline, as mentioned, we just opened this investment on Monday, so it's really only been available for 3 days. We're going to close out funding here by the end of October, with construction starting in November. So again, we'll be delivering the first building in only 7 to 8 months, and that's really our goal here. Starting with those stack flat units, getting those cash flowed and delivered while we finalize and start construction on the mid-rise building next spring. Fully stabilizing in 2028. Looking for a refinance execution or potential sale execution over the next few years after that. As we've talked about, and Josh mentioned a few seconds ago, actually, we're going to just target optimized sale, refinance, like a lot of these multifamily assets. As construction goes, there's the accrued preferred return. We have that interest reserve, and we want to use any of that to potentially refinance, return as much capital as possible, all of their accrued preferred return, and stabilizing cash flow. Whether that means that's a sale. We'll explore that. We're just going to explore the market and do what's best for our investors on whether that's in month 36 or that's in month 60. Really targeting what that optimal time for our investors is to exit the asset or to refinance and return capital.
Absolutely. And just touching on that topic, a lot of our investors will ask us typically, well, what happens if we sell in year 5 or year 6 or year 7? So we're happy. We have a sensitivity analysis that kind of shows what does your IRR do? What is based on exit cap rate assumptions, based on where we are with interest rate environments in 3, 4, 6, 7, 10 years down the road. We put together market-driven assumptions based on revenues and expenses, what our net operating income is, what we believe the exit value is, what the TIF value is based on how many years remaining on the 27-year TIF, to get to what are our sale proceeds, what are our costs. So we have all of this available And we're happy to sit down and walk you through how that's calculated, all market driven, and focused on, as Nick mentioned, optimizing yield for our investors, right? And we can't tell you today if that's going to be in year 3 or year 6, but we can assure you that we're going to execute to maximize returns.
Absolutely. So I was talking about, again, we always have opportunities available. We talked specifically about 2 opportunities today. One is very imminent. We'll be closing here very, very quickly and finalizing the rates for that piece with F Street Iron Block. We have, of course, the Access Apartments, F Street 92, the formal name for it, which we're going to, again, starting the raise, close construction, different deal. Great opportunity here is, again, infill deal in greater Milwaukee. But of course, we have a pipeline of opportunities, whether that's industrial assets we're exploring, ground up multifamily, ground up industrial, acquisitions with strong cash flows. So these are a couple of the opportunities in the states that we're likely going to be releasing here over the next few weeks, or kind of over the next few months through the rest of 2025.
Yeah, and if what we love doing is spending time with our investors to coach them or explain to them what is our investment thesis on these deals, right? For multifamily, right? Public-private partnership, building quality assets in low vacancy markets. If it's on the pipeline of opportunities of some of our industrial acquisitions, what is that value add thesis? How are we creating value for our investors? How are we creating risk-adjusted above market returns for our investors? How are we finding assets? How are we improving value through mark-to-market leases? How are we buying well below replacement costs and repositioning the asset and generating income that current tenants might be paying rent under market? So how do we mark to market those leases to get them to market, which increases the building value, right? So all of these different things that we're focused on a day-to-day basis, we love talking to our investors about that, because if they understand what we're after, we're optimistic that we can obtain your investment, right? Because of the value thesis.
Absolutely. So again, thank you again for joining us. If there are any questions, of course, please bring them up. It looks like we do have a few questions.
Right. Yep. So the question is, are the monthly cash flows consistent with iron for the Iron Block deal? Are the monthly cash flows consistent? So upon closing of this asset, we'll be also executing the negotiated lease with the tenant. Each year, we know what the 15-year rent schedule is. So there's no ambiguity there. There are 2% annual increases on the lease. So we can forecast what our revenue is. And with our debt in place for the first 5 years, we also can forecast that, which allows us to confidently articulate what is our net distributable cash flow for each $100,000 investor.
Exactly. And we'll be able to really show that specifically as we finalize the debt piece of it, depending on the term, if we're fixing for 3, 5, 7 years, as we finalize that over the next few weeks as well. And that also includes the principal pay downs. And that's part of the investment thesis, is the principal pay down of that asset. And that deal specifically, I mean, we know there's $11.6 million of rent payments specifically to F Street Iron Block LLC over that 15-year period. So we know we're buying an asset for 7.7. There's $11.5 million of rent payments. So we have a really good idea of that schedule, those cash payments. So yeah, of course, there's a really good idea of what those will be. Good question.
So I'll handle the first question. The first question was, what happens when my capital is returned in the deal? Do I still receive distributions? In accordance with the waterfall that we highlighted, once you have all your capital back, the Class A investors who are investing the aggregate $2.7 million always maintains a 50% equity position in F Street Iron, which owns the asset. So the answer is, we never buy out your equity position. Once you have your capital back and you're de-risked, meaning you have your preferred return and 100% of that capital back, you will still receive a monthly distribution on this asset in perpetuity until we sell the asset.
Of course. And the second part of that question is can I access my capital earlier? Can I withdraw from it? Because in these deals, like we talked about, you are investing in a physical asset. I mean, we're buying real estate. You own a piece of that real estate. So it is illiquid. That being said, we do have functions in the operating agreement where those can be sold, those can be purchased by the manager, for instance. So if there was ever an opportunity where there was an emergency situation, we could have that conversation because we do have those abilities as part of the operating agreement. But again, real estate is generally illiquid until the capital is returned or the asset is sold.
Yeah. The question is, what is the minimum investment and how can I invest? Great question. We always like to hear that one. Minimum investment is $50,000. How you can invest if you visit us at fstreetinvest.com.
fstreet.com.
fstreet.com. fstreet.com/invest. I apologize. fstreet.com/invest. We're also happy, anyone on our investor relations team, including Nick and myself and Scott, we're always happy to jump on calls to make that very easy for you. It's a great process we've built. A lot of our investors have a really easy time doing it, but we love hopping on the phone and walking you through it. So
yeah,
please do so.
Yeah, always reach out to us. It's Nick at fstreet.com, Josh at fstreet.com. As I said, visit us at fstreet.com/invest if you want to get into deals specifically. But thank you again for joining us today.
Yeah.
We're excited about these opportunities and the opportunities coming up next. We'll talk soon.
Thank you for your time. Appreciate it.